Bloomberg Audio Studios.
Podcasts, radio, news.
This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, I have an extra special guest, returning champion Professor Meir Statman. We've talked a number of times about what investors really want, all sorts of different aspects of behavioral finance. His new book is really comprehensive, a wealth of well-being, a holistic approach to behavioral finance. I found this conversation to not only be informative, but to be rich with both data and anecdotes. He has spent the past 44 years studying this work. Lots of what forms his opinion is data-driven, is based on research he's done, and he really flavors the book with a lot of specific anecdotes. I found it quite interesting, and I think you will also. With no further ado, my conversation with Professor Meir Statman.
Well, I'm so delighted to be with you again, Barry.
So before we get to the book, which I'm really enjoying, I have to go over your background, which is really fascinating. All right, so your academic background, you get a Bachelor of Arts and an MBA from Hebrew University of Jerusalem. You come to the U.S. where you get your PhD in economics from Columbia University. Was academia always the plan?
No, it was not at all. I didn't really know exactly what I wanted. When I was in the army, I was destined to go to a kibbutz, a collective farm in Israel. And I took a course on agriculture. And we had an economist who came and talked about exporting oranges and what it involved. And I was thinking, this is stuff that I can understand that makes sense to me. So I'll pick economics. My dad said, study accounting. That's a practical thing. I thought that my second major is going to be literature, because I did not know that I had sufficient background in mathematics. But I went to one of those psychotechnic tests, and they say you can take it, and I did. So I studied economics and statistics, and then finance for an MBA.
So your curriculum vitae is kind of fascinating, mostly because, as far as I can tell, since 1980, you've had one job. That's 44 years. Professor of Finance at Santa Clara University. You're the Glenn Klimek professor. That's amazing. 44 years, the same school. Has it been the same subject the whole time?
Well, it is the same subject, but the subject itself is changing.
A lot, rapidly.
I'm lucky to be one of those people who is changing the subject. And so it turned out that it is just the right place for me. It is a place that values teaching and values scholarship. So teacher-scholar is the way we describe our faculty, and that is what we strive to be. And it is open, perhaps because at the beginning it just was moving from being just a teaching place to a teaching and scholarship place. And so they didn't really have the notion that it must be a paper in the Journal of Finance or whatever it was.
Right.
Just do stuff that has an audience, and they, to this very day, they're very flexible as to the audience they have in mind. It might be fellow academics, but also professionals and also the general public. And so they're delighted when I write something for the Wall Street Journal, for example.
So you got the PhD from Columbia. How did you make your way to California? That's not the first place you would think of.
Well, when I was studying at Columbia, I was teaching at Rutgers College. And when I got my PhD, I went to the chair of the department and asked whether there's a pay raise accompanying completion of the PhD. And he said, well, the way you get a raise is you go to another university, you get an offer, and then we see if we can match it. And so I went to Binghamton University, which is, and that was the end of February.
Highly regarded in SUNY,
It is
right?
highly regarded and cold.
Right, not a fun place in the winter, especially if you're from a much warmer climate like Israel.
Yeah, and so I went to Santa Clara, and it really felt like home from the beginning. Now, remember, this is a Catholic Jesuit university, and I am Jewish. So, I didn't really know much about Jesuits or Christianity more generally, but it just turned out to be just right. And I say, they're kind of similar. Both begin with the letter J. So,
hey, they both started with the same book, right?
It is a wonderful place. Yeah.
So you're teaching the same subject for 40 plus years, but as we said earlier, behavioral finance and the entire field of economics has clearly evolved over that time. You've been part of that process, pushing behavioral finance through 1, 2, and now let's call it 3 generations. Tell us a little bit about that process.
Well, so I studied standard finance, which we all studied at graduate school then, and in some places still, where people are rational. They are interested only in maximizing their wealth, maybe subject to risk considerations, and that is it. And you say, so what are they going to do with the wealth? And they say, well, that's not our field, that's marketing. I never felt that is right, but I didn't really know how to put it together into something that would look like an academic paper. I came to New York to study at Columbia. That was in the summer of 73, and that was just before the Yom Kippur War and the energy crisis and so on. And Con Edison felt compelled to suspend its dividend. And they had a raucous annual meeting in April of 74, and people were really trying to physically harm the chairman of the board,
really?
Mr. Luce. One woman said, I used to be a husband. Now Con Edison is my husband. Where is my dividend? I live on the dividend. And it occurred to me that contrary to what we studied about rational behavior, it did not occur to them that they can sell a few shares and generate homemade dividends.
Right.
So that stayed with me. And then when I came to Santa Clara, I heard my colleague Hersh Shefrin speak about those issues of mental accounting and framing and self-control. And it just clicked. I said, here is the answer to the issue of dividends. Now, I did not know at that time the work of Kahneman and Tversky. And the funny thing is that while I was at the Hebrew University, the economics building was right next to the psychology building, and Kahneman and Tversky themselves were doing their work there. But I had no idea who they were, their work. None of my professors
That was
mentioned
late
that.
60s, early 70s, though, right?
Late
Like they
60s,
hadn't
exactly.
published and had really become names yet.
That is exactly right. That is when they did their pioneering work.
Wow.
In fact, I went over to do some of those experiments. Later on, talking with them, it turns out that none of them were their experiments. But at least, it kind of gave me a sense. But I just did not know how to connect it. And then once I got to know their work, it really clicked together. And so the first paper that Hersh Shefrin and I did was about dividends. It is about why it is that people like dividends. We were exceedingly lucky to have Fisher Black as the reviewer, as the referee for that paper. And he said, and you're going to see my blush now, he said, this paper is brilliant.
Really? Oh, that's great. That's high praise coming from him.
The editor wrote, after a lot of soul searching, I guess I agree.
So the interesting thing about dividends, from my perspective, I always thought dividends were preferred by investors over stock buybacks.
Yes.
Right? Stock buybacks are arguably more tax efficient. But if you're like those people who are Con Ed investors, if they're living on the dividends, we used to call those widows and orphan stocks, the loss of a dividend is a real loss in income, and people really feel it. Yes, of course, you can sell a few shares, but I'm going to bet those people who either bought that stock or were handed that stock by a parent or a spouse were told, this is a great, reliable dividend payer, never sell it.
Exactly. And people make the distinction between what is capital and what is income. And so the rule that we follow is move money from income to capital, such as 401k, but don't dip into capital.
Right.
When you spend dividends count as income, and so you can spend them freely. But selling shares, that's dipping into capital, you know.
And they've been admonished against that their whole lives.
Exactly.
That pivot, and I have all these examples that I have to hide because I don't want people to recognize them, and we'll talk about them. But in my day job, one of the things that we notice all the time are people who have been workers and savers and investors hit a certain point where they slow down working, they have a ton of money in the bank and in their portfolio, and they have a real hard time making that adjustment to, hey, you don't have to be an accumulator saver. You could start spending some down. Even if you live to 100, you're good. It's a very tough transition.
It is indeed a very tough transition. Yeah, when my mother-in-law was old, she had a rickety old sofa. The kids said, you must replace it. And she said, no, it is just fine. Finally, they just bought a new sofa and tossed the old one. And she smiled and she said, well, you're dipping into your inheritance.
So I had a conversation with a guest who was driving a 25-year-old car. I said, why don't you go get yourself a new car? And his answer was, I'm dipping into the money I would otherwise give to charity. I said, not for nothing, but, you know, the latest cars, they have the emergency stop and the seatbelt pretensioners and the improved brakes and the lane departure warnings and the automatic stop in case you're getting too close to the car in front of you. If you're not around to keep making all this money, you're going to have that much less to give to charity. And about 3 months later, I got an email. All right, you guilted me into getting a new Lexus. I go, listen, the $50,000 you're spending on the Lexus, that'll keep you alive. You'll be able to keep giving money to charity for that much longer.
Exactly. In fact, I just days ago gave my 30-year-old Toyota station wagon to my handyman, and my wife compelled me to buy a Subaru that has all of those good features,
all the safety features, right,
that you mentioned. And it took me a while to make the switch. But
the last time you were here, we talked about compounding and how money grows over time. You just don't recognize how much all these little incremental changes, whether it's automobile technology or your phone or whatever, you know, you don't notice it year to year, but 20, 30 years later, oh my God, it's a much better phone, it's a much better car, it's a much better, things improve over time, and why not have the latest, greatest if it's going to protect you and your family?
It is, yeah. I was reluctant to do it, and of course I'm happy now that I did. I listened to my wife. What can you do that's better than that?
Happy wife, happy life, right? Let's talk a little bit about the book, which I'm finding to be fascinating, and I want to start with a quote from you. Financial well-being alone is not enough. True life well-being comes from living a satisfying life full of meaning and purpose. That doesn't seem like the traditional Wall Street definition of financial success. Discuss.
Well, it is not, but of course it is just common sense. That is, if you just think about your life, when I think about mine and the listeners as well. In finance, we usually end with financial well-being. That is what you should do to get financial well-being. But what comes after that? So if you ask people what really matters in life, they're going to say things like family and friends and work and health and so on, all true. But often they forget the finance part. And so it is this kind of like two worlds, one focused on finance entirely and one focused on things other than finance. But of course, finance by itself enhances well-being. That is, being a millionaire really makes you happier than just earning $50,000 a year. And being a billionaire is not bad. You know, I'm a few million short of $1 billion. I don't really aspire to $1 billion. I'm doing just fine. But money matters, period, on its own. But it also matters because it underlies other things. If you want a sure divorce, make sure that you are unemployed and there's not enough money to support your spouse and children. So you need money for family. You need money for health. You need money for education. You even need money for religion because, they expect you to support the church or synagogue or any other temple that you go to. And so money matters because it underlies everything else. You don't have to be wealthy to enjoy friendship and family and the rest, but you have to have some minimum that will get you there. And from that, you can build on, of course, to get life well-being, life where you can describe yourself as say, having a vocation, not just a job.
So it sounds almost as if you're referencing Maslow's hierarchy of needs. You have to take care of your basic survival. You need shelter, food, clothes. And then the next tier is you want a little bit of security and a little bit of reserve to deal with any sort of emergency. And then beyond that, you want options to be able to spend your time how you want. Is that the wrong frame of reference, or are there parallels?
It is similar to it, except that that sequence is not a sequence that everyone goes through or aspires to. That is, there are lots of people for whom gathering more and more money gets to be the ultimate in what life is meant to be.
The contest aspect of it.
The contest and so on. That is what they're...
And that's the polite way to describe it.
Yes. So I think that Maslow got it right, and I think that I can describe myself as someone who followed Maslow. That is, I have more than enough money, but I also have a vocation. I'm 77 now, and I'm not even thinking about retirement. That is not because I need the money. It is because I am a professor. This is who I am. An emeritus professor, you get the title, but you're no longer connected to students.
You're still teaching classes now,
I
right?
am still teaching classes. I'm still teaching classes. I'm still writing. Yeah, this is my life. I mean, of course, I have... You
have lots of other things going on.
I have lots of other things, right. Yeah.
So that's a perfect opportunity to ask about the 4 kinds of capital you explore in the book: financial, social, cultural, and personal. Let's go over each of those. What makes them all so different?
So financial capital is kind of straightforward. That is, you need money, and money, as I said, underlies everything else. But it is also important on its own. And contrary to a very famous article that experienced well-being, emotional well-being stops growing after you have $75,000 a year.
And that's an old number, right? From a decade or two ago.
But even adjusted for inflation, that turns out not to be true. So,
really?
So a more recent study by Killingworth found that it is not so. Now, Kahneman and Deaton, who did this original famous study, they asked people what emotions they had yesterday. But the emotions you remember from yesterday are not the emotions that you feel right now. The way he did it was working with an iPhone and asking people, how do you feel right now? And people had to make choices now. And it turns out that in fact, emotional well-being, experienced well-being grows without limit, but without limit, but diminishing benefits.
So it starts to plateau.
Exactly.
What's that number where you really see? Because I remember seeing something. I don't know if it was this study. Around 400K it starts to, or is that wrong?
No, so if you go from say 20 to 60, that is 3 times.
Right.
The increment is the same as going from say 100 to 300.
Right.
Which is 3 times. The second one you grow by 200,000, but it really counts in terms of your well-being as an increase in 40,000 when you begin with 20,000.
I got you. Yeah, going from broke to, all right, I have enough money to pay my rent and to pay the doctor and to get food, that's like a big threshold. But going from 100 to 300, or I would imagine 10 million to 30 million, there's a joke I love to tell to clients. What's the difference between $1 billion and $2 billion? And the answer is nothing. there's no difference, right? How is your standard of living going to be affected between $1 billion or $2 billion? It's the same.
Yeah. Well, it is the same, but of course, if you have a fellow hedge fund manager who has a 25 billion,
right?
Boy, you feel like it's puny. You know, I read a book by a sociologist that interviewed very wealthy people living in Manhattan, and a woman whose annual income is in the millions and wealth is many multiples of that. She said, "I guess I'm in the middle. You know, there are people who have chauffeurs that have private planes, and we don't have that."
There's always going to be, unless you're, Warren Buffett or Bill Gates or I guess now Elon Musk, there's always someone that's going to have more money than you. Is that really the way people should be measuring themselves?
I hope not. You know, this is guarantee of being wealthy and miserable. That is not life well-being. It is surely financial well-being, but this is extreme example of the difference between financial well-being and life well-being.
So I just want to make sure I understand the does money buy happiness question. So it starts to diminish, but in terms of proportions, when you're going from 25 to 75 or 250 to 750, the tripling is more or less parallel no matter where you start from.
Exactly.
So you like drugs, you need a bigger and bigger hit to experience the same increase in satisfaction that you're going to get when you're in the millions or billions.
That's right. And once your income is 750 a year, stop. Is
that so?
No.
Is there a plateau?
I'm just describing it from my perspective.
Right.
That is, I ask myself, how much do you need? And there comes a point, such as when you know that your estate is going to be subject to estate tax, where you say, come on, Mayor. Now it's a question of whether you're going to give it to the government or give it to charity. And so for me, I established with my wife, we established an endowment at Santa Clara University to support the work of my colleagues, several $1 million. And I'm thinking, think about it, Mayor. I mean, you have enough.
I always laugh when people complain about the estate tax, which as of right now is married couple over $24 million. To me, it's like the only excuse for paying a estate tax is you're hit by a bus on the way to the estate attorney. You fill out some forms, you sign the documents, and you're donating that money to charity, as opposed to, that's to say nothing about trusts and estates and doing all these other things if you want to move money around. But it's not that hard to not pay estate tax.
Yes, but the question really is, again, about life well-being. So when I told my younger daughter that we have established this endowment, and I said, there's going to be enough left for you.
Right.
And she said, Dad, I already received my bequest.
Oh, that's lovely.
And, truth, I mean, she got quite a lot of help buying a house and so on. And I'm so happy that she is not one of those greedy people who know that they're going to get 10 million and say, but I want 20.
So let's talk about that a little bit. Another quote of yours, life well-being comes when we live satisfying lives full of meaning and purpose. How can we measure meaning and purpose for ourselves? And how, as an academic, can you measure that in other people?
Well, measuring it is really quite easy. Now, it is not as precise, you might say, as saying my income is 100,000 or 200,000. But you ask people, do you think that your life has purpose? And they say, I have a job, I have a family. Okay, but I'm waiting to retire. This is and what will you do? I don't know. I'll play golf and so on. Lots of people are like that, and I count myself among the very fortunate, whose work and career is also a vocation. It is also who I am. And
you're not a golfer, let me guess.
I am not a golfer.
And there's some great golf. I'm not a golfer either. I can't imagine looking forward to doing nothing but golf. that doesn't hold any thrill to me. But some people love it. I mean, I don't know.
I have nothing against them. Yeah. In fact, when I was about to say something along the lines you described about golf and making fun of it in my earlier book, the editor said, there are many golf players who will want to buy a book. Do you want to annoy them?
So let's go over one of the other things that I picked up early in the book, the 3 generations of behavioral finance. So generation 1 of economics, well, the original Homo economist is humans are rational profit maximizers. Behavioral finance comes along and says that's not true. People are irrational. Generation 2 comes along and says, well, people are people, and that what you're calling irrational is just people being normal. You want to expand this in generation 3 to say behavioral finance describes people as normal, but we have to broaden our lens and look at people holistically, see the whole person, see the entire life, and not just look at individual transactions or survey responses.
So let me describe very briefly how it develops. So standard finance, as you said, is people are rational. The first generation of behavioral finance, we found, for example, that people do stuff that is not maximizing their wealth. For example, they trade too much, and doing that diminishes their capital. Or they make distinction between what is capital and what is income. And so we call them irrational. But irrational has this sense that they're stupid, and people are not stupid, or by that measure, I'm stupid and likely you are. I said, look at things like a watch, okay? So a watch has utilitarian benefits, but also expressive and emotional. All watches, even those that cost less than $100, show you the precise time. But when you buy a Rolex, you get not just showing time, but you also get those expressive benefits. I am a man who can afford a Rolex, and you feel proud. Those emotional benefits.
Professor Scott Galloway describes that as it's a way to signal your suitability for mating to the opposite sex.
That is one thing that it does, yeah. That is, but then all the people in married ones still buy those fancy watches. Good for them, that is people signal their status, and the status is about expressive and emotional benefits. And so that was kind of the second generation that said people who buy Rolexes are not irrational. They are normal people. They just care about some other things other than show me the right time. And then I was saying, wait a minute, people want more than those expressive and emotional benefits. People want well-being. People want life well-being. Have you touched on family? Have you spoken about education, about work, about religion, about society? Just think about how whoever wins the election, they're going to be half the country happy and half the country miserable.
Right.
And so it surely affects life well-being as well. And so we have to look at that whole. And as I said before, you need money underlying it all, but money is not enough.
That's really interesting. What led to the recognition that we're going through these different generations of behavioral finance and that it's evolving over time?
Well, I cannot say that it is a general feeling. That is, my sense is that finance generally is still dwelling on the irrational stage. I think I moved forward to describe people as normal. And when I say utilitarian, expressive, and emotional benefits to people in marketing, they say, tell me something new. I mean, we know that. People in finance are still kind of reluctant to do that. And life well-being is really beyond their sense of what finance is. And yet, when I speak about it to my students, they know exactly what it is that I'm talking about, and they tell me stories, their own stories. The graduate student said, 15 years ago, I would have said that what is most important for me is to have money to spend it on myself. But now I have a son, and he's the center of my life.
Your
they
priorities
get it.
change, right?
They get it, exactly. There is more than having money to make you happy.
So I see this book as the logical next step to what investors really want, where you describe, hey, it's not just about I want to generate the most return on my invested capital. There are all these expressive and value-based and even status signaling aspects of people's investments and portfolios, their personal values, what they believe in. At the time, that seemed a little radical to a lot of people. I think it's now become accepted in the canon of behavioral finance. How much of a leaping off point was what investors really want into a wealth of well-being?
It is a natural progression. And so one of the things that I worked on even in the 80s, in the late 80s, was socially responsible investing, which we know now as ESG. And I said, look, there are people who are willing to give up wealth to be true to their values by divesting from fossil fuel companies or whatever it is that offends them. These are not irrational people. These are normal people. Now it is a matter of kind of going further and saying what else affects your life well-being beyond, say, investing in line with your values. And then you get into those issues of education, for example. Education is about getting a better job, yes, but education is about so much more than that. An educated person is likely to be a reader, is likely to be a thinker, is likely to have a different set of friends, and all of that. It is not just about having a better job. It is about life well-being beyond financial well-being.
Really interesting. I'm going to stay with what investors really want. We use a custom index piece of software called Canvas. It's now owned by Franklin Templeton. It's got a lot of different uses because it's a powerful piece of software. So with a custom index, you can own the Vanguard total market, like 800 different stocks. And you have the ability to say, I don't want guns or tobacco, which is a very common request. I was speaking to Jim O'Shaughnessy about it. The New York Catholic bishops say we don't want any drug companies that produce drugs that cause abortion or insurance or hospital chains that provide those services. We don't believe that's consistent with our beliefs, and if we underperform a few percent, we don't care. How significant are people's personal values to their portfolios? How important is this?
Well, it really varies by person. And in fact, I'm one of them who invests in general index funds and then makes donations consistent with my values. But for other people, I have this standard analogy. I say, imagine that you face a potential client. He's an Orthodox Jew. Imagine saying, listen, pork tastes pretty good. It costs less than kosher beef. Why don't you eat pork and donate the savings to your synagogue? Well, everyone understands that is absurd.
Not gonna work. Right.
So I say, look, if having fossil fuel or tobacco stocks in your portfolio feels like pork in the mouth of an Orthodox Jew, take them out of your portfolio. But if not, then it is perfectly okay to separate the two. And I like the term that you use. That's the one I use, values-based investing. In fact, there is an ETF for conservatives and an ETF for liberals. And then there is the Ave Maria mutual fund where they exclude everything that offends the Catholic Church.
That's really interesting. I remember a couple of years ago there was an ETF called Vice, and it was alcohol, tobacco, gambling, but it was all the Vice stocks.
Yeah.
Because some people had been shunning them, they had become cheap enough that I recall for a while that portfolio was doing really well.
It did, and perhaps still does, but most of it really is directed at people who want to poke the eyes or those socially responsible investors.
In finance, I've learned it's all marketing anyway, right? Everybody's...
you cannot take marketing out of finance.
You cannot.
How hard you try.
Let's talk a little bit about another quote of yours. Often overlooked, the financial domain underpins all other domains of life and well-being, including health, relationships, and work. Financial stability enables pursuing other aspects of a fulfilling life. So you were discussing just this a little while ago. Isn't that obvious? Do we really overlook that you need money to do these other things? How do we find ourselves in this state of affairs?
When you speak with ordinary people and you ask them, is money all that matters in life? They would say no. Family matters and friends matter and religion matters and so on. It is just that when it comes to both academics and finance and also practitioners, financial advisors, still to this very day, many financial advisors have the attitude of, I'm here to make you money. What you do with it, that's none of my business. And so you think about that and you say, this makes no sense in many ways. That is, if a client says, my oldest son really annoyed me, I think I'm going to write him out of my will. If you're a financial advisor, you're going to say, well, here's the revision, sign the dotted line. I hope that you're going to say, are you sure? Yes, you're going to be gone when they open the will. Does it occur to you that now brother and sisters are not going to speak to one another? You're going to try to reason with a person and say, there is more than this financial decision. You have to think about what kind of life well-being it is going to bring.
So I'm glad you brought up the concept of financial advisors. My experience has been the best financial advisors are very empathetic to people's whole life. But I want to, again, go back to what you wrote. Good financial advisors must evolve into well-being advisors. They must form emotional connections with clients and provide personalized guidance beyond just investment management.
Exactly. So from a business side, the skills that financial advisors have traditionally prized, that is, they know investments, they know stocks, they know hedge funds. Robo-advisors do that work for a fraction of the fee. You want to realize losses, they'll do it automatically for you. You want to rebalance your portfolio, they'll do that. What it is that you bring is, of course, knowledge. You have to be at the frontier of knowledge of finance. And I liken financial advisors, good financial advisors, to financial physicians, in the same way that, of course, you want a physician who knows medicine, but you also want someone who is listening to you, who is asking you a question, who listens between the lines, that you can disclose to even embarrassing things about your health. And there are embarrassing things about our lives that we are not disclosing to acquaintances, because a good physician is one, when you leave the office, you have a sense that even if the medical news is bad, at least you can see what is coming. You get that sense of empathy. That emotional contact is really what is going to keep that physician as your physician. The same applies to advisors. You cannot promise them, I'll get you a higher returns than the advisor down the street, because you cannot deliver that.
Right.
You can say, I care about you and your family. You can disclose things to me, and I'm going to guide you to, of course, take care of your financial well-being, but also of your life well-being.
Really interesting. So you brought up a doctor. That's a perfect segue to our next question. If any one part of your well-being isn't healthy, if your health is suffering, if you have some sort of physical or emotional setback, everything else seems to suffer. It seems that all of these different parts that you've been describing, our financial health, our social health, our actual physical health, they all seem to be interrelated. How do we maintain a healthy balance amongst all the different parts of our lives?
That really is an issue that I've encountered, that others. Our older daughter, for example, is living with bipolar illness and a mental.
You discuss that in the book.
Yeah,
I
discuss it in the book.
Frankly,
before there was a diagnosis, when we just had kind of an inkling that something is not going right, the therapist said that it is our fault, that we are perfectionists or whatever, and it was just a matter of whether Nava is to blame or I am.
Nava being your wife.
Nava being my wife. And so the family, the children part was damaged, and then the marriage itself was damaged. We let our anguish kind of seep into our relationship, and suddenly, even though I could see that I'll get tenure, that's not a problem, it just weighed on me. And what I've learned over time is to separate things. That is, I think now of life well-being kind of like a portfolio. It has stocks, or the equivalent of that, domains: marriage, children, friendship, education, and so on. Now, some stocks will do very well in your portfolio, some will do very poorly, but you look at the portfolio as a whole. And so we have to look at the portfolio as a whole, and we can kind of transfer returns in some ways, transfer well-being from, say, the work part to the I have a disabled child. And, the fact that my wealth is high means that I can support that ill daughter without constraining myself in terms of consumption. So that is a very good thing. And so I think one is really to learn to move life well-being from one domain where it is extra to one that is missing. There's another one that is really important, and that is disclosure. And I'm very happy that I disclose my own pain, because when you disclose your pain to people, the typical response is they tell you about theirs. And
Right.
It might have nothing to do with kids, whatever it is.
They open up.
They open up. And suddenly you move from being an acquaintance or a colleague to becoming a friend. In an odd way, kind of like for free. You enhance the well-being of that new friend, and he or she enhances yours. It didn't cost you anything. You go home and you say, I feel better just knowing that life is like that, that I'm not the one that God has chosen to inflict a handicap on. That is life, and people manage. And if you can help people, of course, if you can help them in more direct ways, that is wonderful. Nava, my wife, has been a volunteer at the National Alliance on Mental Illness, NAMI, for many years. She has helped so many people and families, and I'm so exceedingly proud of her for doing that. And so it enhances her well-being, it enhances my well-being. We know it gives meaning to life. We know that we are doing good.
Since you brought up your wife, let's talk about what you write about marriage. I don't think I've ever heard it described as the largest financial decision we make. Explain that.
Well, if you can think about it, that is, of course it is.
Right.
It is not buying this stock or that, or putting money in your 401k. Marriage costs money. It brings money and it costs money.
It's also the partnership that you're going to face all these financial challenges through your whole lifetime.
Exactly. And so I tell my young students, I say, I was 22 when I got married, and Nava was 21. Look around you. Here on campus, you see men and women who are worthy of you.
Who do you want to spend the next 50 years with?
Yeah. Who do you think? And if you think that there is this giant marketplace online where there are people someplace who are just your soulmate, forget that. That is, you build your life together. It is a joint enterprise. Deciding to come to the United States from Israel to study for the PhD, I can imagine see a wife who says, no, I don't want to separate from my family, and so on. What would I have done? I'm lucky that my wife went along. And so, yes. Speaking as somebody who has been married for some 54 years,
wow.
I can tell you that a good marriage is a wonderful thing.
So now let's ask the opposite question. What does your research say about divorce and subsequent well-being, not just financial, but total well-being?
I think that lots of people are not fortunate enough to find someone who is really a partner. I'm not even talking about abuse. I'm just saying that people really go in different directions, and it creates strife. Now, interestingly enough, when a couple says that they're divorcing, say to their children, in many cases the children are relieved because they've lived with that strife for a long, long time, and they're kind of anticipating that.
Right.
And they can see that actually going from father to mother is not the worst thing. It is actually better than watching them bicker.
It's a relief.
It is a relief, exactly. So when it comes as a shock, when you totally did not expect it as a child, that is painful, and it takes a while, if ever, to heal. But when marriage gets to be so bad that it really seeps into everything, where you think about it at work, where it affects your health, and so on, there comes a time to, like a company that abandons a project without throwing good money after bad,
Well, sunk cost fallacy is a big deal, right?
Yeah.
At a certain point, you got to take the write down and move on.
And very often people will say, I should have made this decision 5 years ago.
Let's talk a little bit about education and a college degree. Some people have argued, no one really needs a college degree. Economists like Nobel laureate Angus Deaton has written, it's the single most important dividing line in terms of lifetime wealth, happiness, well-being, health even. What are your thoughts on education and getting a college degree?
I definitely agree. People say that the value of college education has declined. I say to the contrary. I remember in my first days at Columbia, I was reading something, perhaps a Newsweek, quoting an assembly line worker at an automobile company saying, I earn as much as an assistant professor. And he was right. My first job at the City University of New York in 1975, I earned $13,500 for the year. But, of course, now I earn multiples of what a blue-collar person is earning.
Right.
And on top of that, my life well-being is higher. That is, I really enjoy reading books. I enjoy making sense of the world. I enjoy teaching. There's nothing wrong about being a handyman. I have the most wonderful handyman, both in terms of skills and a person. But, he does not have that college education. His range of interests is different. Not necessarily worse, is different. I can see that it would not have worked for me. And so both in terms of financial well-being and in terms of life well-being, you're really doing better as a college graduate. And so if you are qualified, if it is for you, do that. And if you are not sure, begin with community college, figure it out, work at it. It's not easy. There are days when you would want to quit, but give it a chance, because without it, you're going to be at a disadvantage. Even if you own 3 houses, even if you own a business and you make a ton of money, there is a sense that something is missing.
You devote an entire chapter to striking the right balance between saving and spending. Why is it so difficult for us to reach that sort of comfortable balance, especially when you're younger, when you want to go out and have a good time and buy things, but really the sooner you start saving, the longer it can compound for?
That is right. It is hard to save, especially when you're young, because there are many needs and there are many temptations. If your friends are going to go to this bar and it costs a good chunk of money, saying, I cannot afford that, I think I'm going to say goodbye now, that is very, very painful. And so we use techniques, mental techniques, to help us. I talked before about this framing and mental accounting and self-control. That is, if you contribute money from your paycheck to the 401k, you don't see that money,
right,
and so you don't spend that money. If you follow the rule of don't dip into capital, it means that the moment you say, I think I'm going to dip into my 401k, there's going to be a voice in you that says, no, I don't think that is the right thing to do. And so young people figure out a way to use those mental tools to get them to save and spend, but spend sensibly. The problem arises when those young people get older, and now they find themselves as being, as I am, accidental wealthy people. And now it is a matter of, hey, buddy, relax, okay? You don't have to buy stuff on sale. You don't have to go for early dinner at a discount. You can fly if it is a long flight. You can fly business class even if the price is outrageous. For many people, saving and being frugal turns into miserly, and they find it really hard to break that habit. And so it is really hard. And I hope that their kids or their friends are going to say, hey, relax. In fact, I have a friend who says, listen, if you fly economy, your son-in-law will fly first class.
That'll teach you. You know, I have a colleague, Nick Majuli, young guy in his 30s. He's our quant. And he has this mental device he does. If he wants to go out and buy something, let's say it's a piece of clothing or something, it's $500. However much that item is, he has to match it with a contribution to his 401k. So he'll say, if I'm going to spend $500 on some piece of junk, I also have to put $500 as an investment, and it forces him to spend very responsibly.
That is a very good technique. Whatever works for you. For us, you know, now that we fly business class when we go to Israel, for example, we've also increased our charitable contributions by at least that amount and more.
So you're matching the expensive plane ticket with a charitable donation.
So I say, you know, I treat myself well, but I'm treating those who have less well as well.
That's great. So I've seen some data that shows a correlation between the time people spend with friends and families versus the time they spend working with coworkers and the impact on overall happiness and life satisfaction. Tell us a little bit about social capital and how people use that.
Well, social capital has to do with your circle of friends. Close friends and acquaintances that you can rely on. And so some of them are really close. Some of them are close enough such that you can say, I'm short of money to pay the rent. Can you lend me $2,000? Some cases, they're going to say, sure. They can do that, and they will do. But then there are also acquaintances. For example, if you've lost your job, you know that there are other professors who you know, and you can call and you say, hey, Joe, do you know of any openings? Or if your son is going to apply for college, as a professor, you can call and say, give me some pointers as to how to write an essay that is going to be compelling to the admissions people. And so there's kind of a range of people who are friends. And one of the things is really for higher socioeconomic people, that is people with higher education and higher income, they have many more of those casual friends that they can call for
bigger
job
network
references, exactly, a network. Whereas for the people in lower ones, there is a smaller but tighter, closer circle of friends where you can say, you know, can you give me a ride to the doctor because my car broke down, or something of that kind.
So that's social capital. Tell us a little bit about cultural capital.
Well, cultural capital is about knowing what is the right thing, what is acceptable. And sometimes it can be confusing. That is, here we are at a time when you're not really sure if you should appear with a tie or without, if you're going to go on television. You're concerned that if you have a tie on, you're going to be the only one with a tie on or the only one without a tie on. And so you need to know what are the things that are acceptable, what kind of clothing, what kind of books, what kind of movies are the kinds that you can talk about with your friends, with the people in your circle. And I remember when I came from Israel, I did not really know, the Americans were like a tribe in the Amazon. That is, what is it that makes them tick from small things to large?
Very different country than Europe and elsewhere.
Yeah, I grew up in Israel. People say, aren't Americans very materialistic? And you say, well, you have to go to Israel, or at least at that age, because at that age, getting a car was a big deal. Not in the United States,
Right.
That is,
Especially today.
Well, yeah, we had this kind of joke, half joke, how serious. Do you have Formica in your kitchen? Because it was, you buy an apartment, but can you afford also, at that time it was fashionable to have cabinets kind of laminated with Formica.
Now it's the granite countertops with the nice wood cabinets.
Exactly. You have to know those things. Even if you are going to go against that grain, at least you know that you're against the grain. My mom would say, listen, suppose that you're going to be the Israeli ambassador to Moscow, and they call you to the Torah, and you don't know what to say. Think about it. That is, knowing what to say when you're called to the Torah is part of cultural capital that you need, not necessarily just as an Israeli and Jew, but really as one who strives for a particular position.
So I want to ask you a question because it's an election year, and the chapter you wrote on societal capital. You write, liberals tend to define fairness in terms of equality. Conservatives tend to define fairness in terms of equity or opportunity. What are these two tribes doing so differently, and is there any chance of common ground between them?
Conservatives generally say you're going to be paid as much as you put in. So if you put in a larger portion of the pie, you will get to eat a larger portion of the pie. Liberals say, there are some people who are, say, disabled, or some people who, for some reason or another, not because of laziness, are not going to contribute as much. Well, they might not get as large a piece, but surely you don't want to condemn them to starvation. How much responsibility do you have for others? And so you have that difference in points of view, and it really varies. In Europe, for example, people are more content to pay higher taxes that pay not just for their services, but also for the services of people who are less fortunate. In the United States, there is less of a willingness to do that. Socialized medicine. I mean, what can be worse than socialized medicine?
Dealing with an insurance company is the
Dealing
answer
with
to
an
that.
insurance company, precisely.
Well,
Yeah.
although there's a series of trade-offs that when you have private medicine, you have options and you could do different things. People in Canada, I know, complain about long waits for very simple services.
Exactly. And there are drawbacks to socialized medicine, and there are drawbacks to capitalistic or private enterprise medicine. And some people are going to say, well, everyone has to wait if it is not urgent surgery. And others say, hey, I can get the surgery in the United States the following day.
So before we go to our favorite questions that we ask all of our guests, I just have to ask, I know you've been speaking to people about the book. How's it going? What's the reception been like so far?
It is a very good reception. In some way, what I say is not new, and in other ways, it is very new.
The way you've structured it and the way you tell the tale and organize this feels very new, even though I recognize a lot of the concepts from your earlier books.
That is right. So there is a lot of literature about life well-being, say done by psychologists, done by economists, done by sociologists. People in finance don't know this literature. And of course, like all academic literature, it tends to be kind of general, that in general, divorce does not necessarily harm well-being. But tell me a story, illustrate it, so that it kind of brings it to life. And so my task was to learn and bring the academic literature, the general literature, and then marry it with stories from everywhere.
So it's data plus anecdotes. Someone I know has a child that's going to go to grad school next year. This person has $10 million worth of stock, cash, real estate in the bank. All he does is complain about, this kid's going to cost me $150,000 a year. And my argument with them has been, aren't you saying this backwards? Shouldn't be saying, boy, I'm fortunate that I could spend $150,000 on my youngest son, and it's not even going to move the needle in my bank account. Are people so obsessed with money that they forget what a privilege it is, what a joy it should be to say, you want to go to grad school? Done.
Absolutely. Yeah, I saw an article just recently about someone who says, how is it that people who are very wealthy in 3 generations, it's kind of from shirt sleeves to shirt sleeves. And so he says, maybe you should have fewer kids. And I say, whoa, you really got it backwards. You know, that wealth is for people. People are not for building wealth. And if you are lucky enough, talented enough, hardworking enough to accumulate that wealth, be grateful and have your kids live a bit better. Now, help them find a vocation, okay? Of course, you care about them not growing up to be spoiled brats. Help them as you can. You know, the last thing you want is to hold on to that wealth. Mm-hmm. You die at 95. The kid is 65. Right. Now he gets that money. Well, thank you very much. Right. You know, it's still good to get $10 million even when you're 65. But it is their 20s and early 30s is when they need that money. This is the time to give it to them.
So let's talk a little bit about that struggle. Warren Buffett very famously has said, you know, his kids are going to get a couple of $1 million, but they're not going to be wealthy. And he's giving away most of his money to charity. At what point do you run into the risk of spoiling the kids?
I think that these are not two things. They really come together. That is, you have to help your kid, if you can, buy a house. Mm-hmm. Or pay for education. At the same time, you want to say to the kid, I'm paying for college or for most of college. Here is your responsibility. Your responsibility is study hard. Okay, this is not a time just for play. It is the time for you to study so that you can develop as a person and as a professional so that you have a vocation. Those things go together. Kids kind of get the message. This is not free money. My parents are trying to guide me towards financial well-being and also life well-being. And I have to do my share.
What do you think about the parents who say, all right, we're going to pay for your room and board and tuition and books, but your half of the bargain is you have to maintain a B+, so I know you're not just out having too good a time, you're actually working.
I think that it is reasonable. I think that it is reasonable to set expectations where you do it with a grade point average or other ways. It is really important for people to help their kids. I'll tell you a quick story. Mm-hmm. I was listening to a session that had to do with very wealthy people speaking to other wealthy people. And one of them had a daughter who was not interested at all in academic studies, but she was really very interested in art. Mm-hmm. And in an earlier session that day, somebody came to speak about art as an investment. Mm-hmm. And that gave him an idea. And he said, what if I open a gallery for her? It will really be the right thing for her. Will it make money or not? I don't care. I have plenty of that. But it's going to be a vocation for her. He had tears in his eyes. He was so relieved that part of his well-being that was so low is now going to be high. And I was thinking, that is wonderful. You know, this is why I repeat this story, because it really touches me deeply.
A clever solution. All right, so we only have about 10 minutes left. Let me jump to our favorite questions that we ask all of our guests, starting with what's been keeping you entertained these days? What are you watching or listening to?
The podcasts that I'm interested in are ones that have to do with society. So Ezra Klein, for example,
Sure.
who has podcasts about society and how society operates and how government. This really resonates with me because this is something that I would like to know. I'm less interested in the usual fiction series and so on, which is not a very good idea because that's part of cultural capital. And so people make references to shows I've never seen, and it kind of puts me in a defensive position.
Yeah, you don't strike me as like a Bridgerton sort of guy. Like you're not streaming that sort of stuff on Netflix.
No, I don't. And
it's cotton candy. Some of it's delightful.
I'm sure, and really kind of like golf. It's not my thing,
right.
but I don't resent people for whom it is their thing.
So let's talk about mentors who helped to shape your career.
Well, I can think of Eliyahu Harris, who was my teacher in high school. And he came from the United States. He graduated from Harvard, and he is a Zionist. Before he came, my teachers of English in both elementary school and early in high school taught it through grammar. I cannot take grammar, not even in Hebrew.
But by the way, I just finished a word with a preposition, and in the back of my head, I see that little X. You're not supposed to end a word with a sentence with the word to, and sometimes it just happens.
Who cares?
Right.
And so the first assignment he had was to write an essay. And suddenly I moved from the bottom of the class to pretty much the top of the class. And students came to him and said, why did I get a C minus? I had no spelling mistakes. And he said, that's not what mattered. An essay has to be interesting. On one of my essays, he wrote, very good indeed. And I didn't know what indeed meant.
That's great. Let's talk about some books. What are you reading now, and what are some of your favorites?
So I'm reading now or read recently Streets of Gold. It's about immigration into the United States, the waves of immigration, immigration laws. And it begins with a story of someone at the turn of the century, the 20th century. And he said, they told me that in America, streets are paved with gold. Well, I found three things. One, the streets are not paved in gold. Second, the streets are not paved at all. Third, they expect us to pave them.
That's very funny.
And so you kind of learn that the immigrants themselves did not really move from rags to riches, but their kids have done better than American kids.
Why is that? I've watched that firsthand, and I just always assumed the parents said, hey, this is an opportunity we didn't have back home. Take advantage of it.
That I think is a big part of it, really. There are those expectations that you place in your kid, or it may be the kids themselves kind of get without being told. The Uber driver who took me yesterday from the airport, he said, he works as an Uber driver. He does not earn a ton of money. And he said, it's for my kids. And indeed, they're going to get better education and have better chances than they would have had in his home country. And so if you look at immigrants today, it's the same story. That is, people are afraid of immigrants and so on. But immigrants, and of course I'm an immigrant, so right. I'm biased, but I think that immigrants add a whole lot more than they take away, especially if you count the second generation and the generations that follow.
So Streets of Gold is one book. Give us one other.
I'm also rereading a book that is called The War of Return. It is about Israel, Palestine, and it's about the demand of Palestinians to go back.
This is before the current
long before
conflict.
Yeah.
This is decades.
There's something very anomalous about this notion of refugees. That is, my parents were refugees when they escaped from the Nazis from Poland. They were refugees in the displaced persons camp in Germany, where I was born. But they ceased being refugees when they came to Israel. And of course, my children and their children are not refugees. Somehow, Arab nations, it has come that Palestinians are refugees even if they were not among those who were made refugees in 1948. So it's their children and grandchildren, and they still have this notion that they're going to go back to Ashkelon and Jaffa and Haifa and so on. And, the sense is really that unless we kind of get away from that and we get to know that people make their lives where they are, there will never be peace.
That's a big challenge. All right, our final two questions. What sort of advice would you give to a recent college graduate interested in a career in either investment advisory, finance, or academics?
Well, what I would say to people really is what I'm saying to interns when I send them into internships. I say, think about serendipity. Think about zigs and zags. That is, the most important thing when you get out of college is get a job. Any job. You're going to learn from it. And if you hate this job, that's a very good lesson because you've learned something not to go there. And so life is going to take you in many directions. Keep your eyes open. Learn not just about the world, learn about yourself. Now, academics turned out to be the right way for me. I'm a professor. This is my vocation. But it is not for everyone. If you are a financial analyst and that is what you do, you may aspire to be the chief financial officer, maybe the CFO of a company. Good for you. There are going to be many surprises that you're going to encounter. Do that. And so don't try to chart your life and career too far ahead. Just let things develop where you figure out the world and you figure out yourself.
And our final question, what do you know about the world of behavioral finance today you wish you knew 44 years ago or so when you were first starting out?
Well, in a way I would like to have known everything I know now. But in a way, I'm really happy I did not. That is, in a way, I'm happy that I let things develop, that I discovered them as I did. It's kind of like opening gifts one at a time, one every year, and be surprised and be delighted by them. And that is what happened. If you think about those generations of behavioral finance and the subjects that you have, the new ideas, things I could not understand at night when I'm tired and ready to sleep, I wake up in the morning and I get that. So I just thought recently about this idea of well-being as a portfolio. And I was just corresponding with an editor of a journal, and she said, I really like this idea. Yeah, can you write a paper about that and tell advisors how they can use that in a conversation? I'm up to this challenge. This is the kind of thing. So for me, one of the pleasures of life is really discovering new things, making connections that other people don't. This is my comparative advantage.
Well, that's just delightful. Thank you, Professor Statman, for being so generous with your time. We have been speaking with Professor Meir Statman, author of a new book, A Wealth of Wellbeing, A Holistic Approach to Behavioral Finance. If you enjoyed this conversation, check out any of the 500 previous discussions we've had over the past 10 years. You can find those at iTunes, Spotify, YouTube, wherever you find your favorite podcast. Check out my new podcast, At the Money. Short 10-minute questions with experts about topics related to your money, earning it, spending it, and most importantly, investing it. At the Money in the Masters in Business feed or wherever you find your favorite podcasts. I would be remiss if I did not thank the crack staff that helps put these conversations together each week. John Wasserman is my engineer. Atika Valbrun is my project manager. Anna Luke is my producer. Sean Russo is my researcher. Sage Bauman is head of podcasts at Bloomberg. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.